Hello, and welcome to the March Market Update. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. We've got a lot to talk about this month. First, the U.S. economy, despite a bit of a slowdown, is actually doing quite well. Second of all, we've seen a lot of positive signs in the rest of the world, which are also something to cheer about. And third of all, markets are responding. We've seen a significant rebound since January, which was not a good month. So let's start with the U.S. economy. I live in New England, and when I look out the window, I see cold and snow, a lot of it. What's interesting, though, is this year is actually much better from an economic perspective than last year. If you remember last year's first quarter, the weather was terrible and the economy got killed. This year, that's not the case. Although there are some signs of weakness, for example, manufacturing is down a bit and factory orders have dropped a bit. They mainly relate to the rest of the world. If you look at the economic factors that affect the U.S., we've seen earnings, average hourly earnings, go up by the highest level in quite some time. We've seen hours stay constant. We've seen consumer spending grow at a rate that no one expected. All of these are very, very positive factors for the U.S. economy. Despite the winter, despite the weakness, despite the troubles abroad, we're actually doing really, really well. Even if you look at the troubles abroad, Europe is the biggest risk area out there. We're starting to see some green shoots. Germany continues to grow, but even in some of the hardest hit economies like Italy or Spain, we're seeing signs of growth. The biggest risk factor out there, Greece, which very well could have blown up last month, actually came to I wouldn't call it an agreement, but at least an agreement to disagree that laid the groundwork for further progress. We're not out of the woods on Europe yet, but the signs are actually rather positive, and the fact that Greece and the creditors could agree suggests that that is not going to be the problem that the markets had assumed that it might be. The last piece of it, the markets, if you actually look at how the markets did during the month, they're up about 5 to 6% across the board. What does this mean? It means a couple of things. First of all, despite the risk factors that the market was looking at in January, after further review, if you look at the strong dollar, for example, if you look at the weakness in Europe, the markets have come to the decision that things are actually not that bad, and that's a really good thing. Second of all, if you look at the fixed income markets, which are typically a lot more pessimistic than the equity markets, they, at least here in the U.S., are ratifying that things are getting better. We've seen interest rates creep up over the month. Now, that's actually, it can be interpreted as a bad thing, but right now it's a good thing because it reflects the normalization of the economy. The Federal Reserve has been all over the map on this, but in their most recent commentary, it was very positive about the recovery of the economy. Make no mistake, risks remain, and there are things we have to watch out for. But when you compare where we were with last winter, we've got more snow now, but also we've got a considerably warmer trend, at least for the economy here in the U.S., and the markets are reflecting that. As for next month, I hope to tell you spring continues, but we will see. I'll talk to you next month, and thank you for watching.